with the fallout from the collapse of Signature Bank and Silicon Valley Bank. Here to talk about what comes next, Democratic Congressman Khanna of California. His district is in the heart of Silicon Valley. And Emil Michael, former chief business officer at Uber. There's a lot of worry about contagion. Now it's Credit Suisse. We saw Signature Bank. We know First Republic is having problems. How worried are you? I'm worried because what I think is going to happen now, if I'm the FDIC, I'm going to go look at every other regional bank, every other specialty bank, and I'm going to see what's happening on their balance sheet. And we're going to find some rot there because of the rate raises that happen so fast. Management teams make mistakes, as you've talked about, and there's no way this is an isolated incident. So you're going to see some pain. Now, depositors are going to be covered, so you're not going to have panic, but you're going to see rot. That's my view. I want to remind our audience of that. Depositors. This is not saying that there's not going to be more banking fails or a crisis, but depositors in this country are going to be protected. That was always the case, up to $250,000, and the president has assured us beyond that. Congressman, I've seen you over the last week saying it was important to create this backstop for Silicon Valley Bank. They did a special thing, this bank. They were the one bank that really supported startups. Well, why do we need that? Just because it's called a startup, just because it's cool and it's in California, doesn't mean that that business should be getting some sweet loan terms. Maybe there's a reason no other bank wanted to loan to them.
Well, I think it's fair to say that any regional bank should have deposits guaranteed right now if they were going under. And the problem that I was concerned about is that you would then just have all the deposits move to the four top banks. This for me was about actual businesses that employed real people that were trying to make payroll and the potential that people were going to pull out deposits from a regional bank and give them to New York. In fact, I think the president would have been more likely to act faster if this was a regional bank in Ohio. Part of the problem was it was in Silicon Valley, and people don't want to support tech folks because they think they've done really well already.
Okay, but hold on a second. I mean, I get that companies need to make payroll. How many small companies wouldn't make a week's worth of payroll or 2 weeks if you've got $250,000 covered? And once you did the workout, you are going to get 60 or 80 cents back on the dollar either way.
Well, two things would have happened. One, people would have started to pull their money. If you had only done an advance deposit, taken it to J.P. Morgan, you would have seen other regional banks fail. Then there are companies like Rippling, which had 400,000 people on their payroll. Look, some of the best companies, the VCs would have figured out they would have done bridge loans. But if you had 1,000 companies fail, which is, let's say, 2% of the companies, and all the layoffs, I mean, do we really want this? So I just think they didn't have many good choices there.
Do you think we're going to look back on this and say this may have been the first bank run that was fueled or supercharged by digital banking, because now all you need to do is swipe and pull your money, or more importantly, social media, where you had a number of influential people who could have contacted any bank, any CEO, any congressperson, and instead used the power of social media to shout fire in a movie theater? For sure on the first one. The fact that you could do wires from your home with dual authentication, you get a text and $1 million goes out the door. That's going to happen fast. And that's over. That's never been before. That's never been happened before. On the second thing, this whole notion that Sachs or Khanna on Twitter had fueled this, it's just not, I don't feel that's accurate. They didn't start tweeting until Saturday, and this thing was gone by Friday, right? The FDIC was in the offices on Friday, and they were in Signature Bank on the weekend. So I don't think it's a Twitter thing, but I do think the speed of information, the speed of money movement, all that is the new reality. That is what we're living in now. Then in terms of what needs to be looked at in the autopsy of all of this, what do we need to focus on? Because whether it was malfeasance or mistakes, we got to review it.
First is more regulation. I mean, in 2018, they basically deregulated Silicon Valley Bank. I mean, Greg Becker was lobbying me and others saying, we don't need these regulations. We don't need a liquidity test. We don't need a stress test. Guess what? If they had done a stress test or a liquidity test, they would have figured out you don't hold long-term bonds while interest rates are going up.
But that's not a license for bad behavior.
Of course
not. Like, I get that it's like one political party wants to blame this guy, another blame this guy. However, and I said it here last night, like, if I don't lock up all the vodka in my house, it doesn't mean that my 16-year-old is clear to drink it all and go get behind the wheel. So just because every letter of the law isn't, we don't cross every T and dot every I, doesn't mean bankers need to treat this like the wild, wild west. Shouldn't they take some accountability?
Absolutely. I've called for a clawback of their stock sales, of their bonuses, of their executive pay. I think there has to be an investigation into the executives and management team. I have no sympathy for them, and the shareholders and bondholders should go to zero. But the reality is we regulate the 4 top banks in a different way than we do the state banks and regional banks. And I think the deal has got to be, if we're going to protect depositors in these regional banks, they have to submit to greater scrutiny and greater regulation.
But here's the problem. What's happening to the 4 biggest banks this week? They are having more money come in than it's like winning Powerball. It is raining money inside the halls of J.P. Morgan this week. So the effect of this has been people flooding to those big banks. What do you do about it? Because I know that's not what we want universally. We need our community banks.
I think we have to figure out an insurance scheme that is accountable.
Let's not call it a scheme.
Sorry, an insurance plan, an insurance model that is relative to the risk that these banks are taking. So if you're going to take a risk on some of these long-term treasuries, pay more insurance and let your depositors know that this is a risky, you're taking a risk. You may be getting 4%, but you're taking risk. And
I like that. The more risk you take, the more insurance you pay.
That's on you. And the more insurance you pay, and you have to have a risk management structure that can calculate that.
Are you asking where's the San Francisco Fed in all this?
Well, I'm asking where are the California regulators, because the California regulators were supposed to regulate a California bank. But one other thing we could do is we could say, look, the banks have to pay more premium. You made good points earlier that will let go to ordinary depositors. Well, you can mandate that higher accounts pay a larger fee for that premium into the insurance fund so that the person who has less than $250,000 isn't paying the fee. But if you've got $3 million, $5 million, you are paying part of that bank fee.
When we look at this, should, whether it's the Fed or the FDIC or different regulators, start to look at not just how many deposits banks have, but who the depositors are and the concentration. It was clearly unique that it was a correlation of 1. Everybody with their money at Silicon Valley Bank was in the same business.
Well, Silicon Valley has, Emil, I think, would attest to this, a bit of a herd mentality. You know, when I got my first supporter, every other person wanted to support me. And I think when you have these VCs with large accounts, when you pull out, it's a problem. So they were not diverse for 2 reasons. They weren't diverse in industry, and they didn't have diverse accounts. You know, it's hard to have a run on Bank of America. You got a lot of people with a lot of accounts. When you have big accounts, that is more susceptible to a bank run.
I'm out of time, but I have to ask, how worried are you about how fragile the markets are? This is different than 2008, but rates are high. They got high quickly. They were at zero forever. We had crypto. We had SPACs. We've had a lot of crazy things happen.
I'm worried. I think the capital markets are frozen right now. I think we're going to wait till the next Fed meeting to see how the Fed is going to react to this. Whatever they were going to do, my guess is they're going to do less of it. But who knows? And when who knows means volatility, means fear, means freezing.
Do you know why I bring on the experts? Because I want to hear who knows.